Everything is on for us here. Yeah, looks good. So good morning, good afternoon, good Wednesday to everyone. Thanks for joining us in our mid-session or weekly session. My name is Vladimir Ribakov. I'm from Home Trader Club, and if you are watching us for the first time, welcome on board. You are more than invited to watch the previous videos where we discussed some very interesting trading opportunities, the way they build up on the market. And in today's video, I would like to follow up, check how they are developing, and make some follow-up plan on some of the instruments we've been following in the last 2 weeks. So I'm here with you in pretty much whole April. So that means next week on Monday and Wednesday, I'll be here with you as well. You're more than invited to join us in real time on Monday, and of course our mid-weekly session next Wednesday as well in live webinar. And with this opportunity, once again, I would like to thank Eightcap for making such an amazing event. And I really hope you find the value in them to see and to learn how different traders find opportunities in their trading and what lead them to make the decisions they actually do. How do they analyze? What methods do they use? What do they pay attention to? All that is from my point of view, the best lessons. When I started my journey, it was more than 15 years ago, and I was missing that. So I hope you guys really find value in that. So before we go to the charts, let's take a look quickly on some recent data we saw yesterday. And for that, I would like to go to the Eightcap members area in the economic calendar. Take a look on the data that was published yesterday. Some of them are very, very important. I'll mainly focus on that. Okay. Look how seriously negative compared to the previous results and compared to the forecast, the housing starts and the building permit change in the US. I think it's dramatic numbers. I was listening to some very interesting interview the other day, and some analysts actually anticipate the current building up pressure with high interest rates, with the pressure on the banking system. We saw recently several banks going into these very, very, very tight situations where they needed money. Like what happened with Swiss credit might be just, the first case. And according to research, TD Bank is under risk. Deutsche Bank and many other more banks are actually, JP Morgan, are actually under serious, realistic risk if this thing will continue. Now, why specifically do I pay attention to these numbers and also here the 52-week bill auction, which I'll show in a moment. So the reason is very, very simple. Banks lend money under some percentage, right? That's the percentage they actually could lend the money, and that's what they give it to us, the people, under higher numbers, and they will have to pay small numbers back to the source where the money comes from. This is how they sell their bonds, they do the other auctions, and so on and so on, and that's how the money flows. The rates go up, the pressure starts go higher, not only on the banks that now have to pay higher than they actually got the money, but also on from other sources, from us, the people. The last week, the retail sales in the US was under a free fall, negative, seriously negative numbers. Now think about it. The economy doesn't matter how they try to twist it or how they try to present it. The real economy was and always will remain us. Us. Okay? The people. Why? Because if we do not spend money on whatever, cars, gas, traveling, right? Tourism is very serious source of money flow, houses, and so on and so on, then the economy starts to get stuck. And that means we are, at some point, we, the people, would not be able to pay the banks. So the banks would be, from one side, they do lend the money to us, right? The people, but if we are unable to pay it back to them, and they are unable to pay it back further on under their own percentage, that this becomes like a very, very, very serious stressful situation for the banks and everything. And if they're not able to deliver, the Fed will eventually, the Fed or other financial systems in different countries would have eventually to go and to take some action. So according to some analysts, they anticipate this mini crisis to be even worse than it was in 2006, 7, 8. Of course, nobody can predict, nobody knows. Only time will tell, will it or not. But the recent numbers, and of course, the CPI getting better and so on, everything is correct. But let's not confuse, because sometimes, you know, the light might look like too bright when one data comes very positive. The CPI dropped down to 5% annual increase. It's still 3% more than the target goal. I take US just for example, doesn't matter, it could be anywhere, Australia, Britain, Canada, doesn't matter. They all pretty much follow up, even though in Canada it's, according to the officials, slightly better. But it's still 3% above the target. It cannot drop down to 2% if there will be no further actions. So like it or dislike it, the Fed is still under pressure. From one side, the banking system, which they are pretty much unable to let it remain under constant pressure all the time. They will have to do something. They don't want the banks to crash and then go for bailouts, right? From other side, the interest rate, they still need it lower. Why? Because with high interest rate, the real fuel, the real gas of this economy or the money flow, us, the people, would not be able to bring back the money to work. Okay, and these recent numbers, of course, even the short-term, the bill auction. Okay? What do I understand from that? The risk, the instant risk, is here. Nobody believes in a short-term fast, let's say, recovery or anything like that. People believe it's still going to be long. Well, not as people, analysts believe it's still going to be long, potentially hurt. And these recent numbers are the real concern. Yeah, I know, of course, mostly we pay attention to the numbers like the CPI, the GDP, the interest rate, and that's it, right? And it's easy to ignore the little signs, like the retail sales last week, or these housing starts and building permits, right? Or the 52-week bill auction, for example, was published yesterday. And I wanted to start with that because, for me, of course, I'm not the Fed, and I'm not a master degree in economy, but I do know that, at least from the previous experience, right, with all the crises, that eventually it's us, the people. Doesn't matter how they twist it. or what do they try to present? If we cannot make this flow of money constantly going in the markets, in different markets, housing, cars, some, I don't know, brand shopping, whatever, okay, it's going to be a problem. Okay, doesn't matter how the Fed will twist it and how many bailouts they will go. If we can't spend money, if we have to, you know, count every single bill and be stressful, and we can't, at some worst scenarios, pay back to the bank, then nothing good will happen. So it's very important to pay attention to these numbers, and I think that the Fed is somewhere, you know, now in a critical position with the recent numbers. I don't think the Fed has too much options rather than slow down the interest rate hike, but it doesn't mean that it's over. It could slow down until the numbers would really change, but it's important to remember that with 5% annual CPI versus 2% target, it's still a big gap, more than 100% gap, right? So that's, with that being said, let's take a look on the technical things we have on the chart. And I'll start with gold, because we were talking about gold in the last couple of weeks. And right now it is making the pullback we were talking about, and very likely preparing us for the next buys. So you remember I mentioned my long term. Okay, let's go back to the long term charts. I will quickly to remind you what and why. I do believe that the gold should create final high here, or at least, right, twist for a while until it will complete the double top and the bearish divergence, which eventually, I believe, should take the gold prices down. Okay, so will we get all-time high? Very possible. In the technical conditions, most of the times trends end after 3 waves, and really slowing down trends usually end in such format, in a decreasing structure, when the first leg is the longest, then the second leg is shorter, and the last leg is the shortest, and then building up the conditions which called negative divergence. When the market is making higher highs, the indicator starts to indicate, yes, it's just indication, of course. The price will eventually have to dictate, right? But these situations usually are the situations where the pressure builds up, and the indicators indicate that the buyer's power, or the buyer's force, is decreasing. And at some point, sellers, you know, they are like hunters, right? As soon as they see the target, they shoot. So same could happen here with gold. And with that in mind, I go to the higher time, to the lower time frame. Sorry, I go to the lower time frame, and what we see here when we're talking about that we are currently flirting around a strong supply area with a slowdown condition building up on a weekly chart, which means very likely we are going for some pullback before further continuation. And going down to the daily chart, what we will see here is the Bollinger Band, the indicator I mentioned a lot in the last couple of weeks. That's one of the indicators I really love to use in my analysis. And when red clouds appear, usually the market makes good pullback before continuation. And we saw a couple of times when a red cloud on the upper Bollinger Band caused the price to fall and ended up with a blue or bullish flip, like here as well, and then make the push. So right now we are in a corrective structure. I do not think at that point that the trend changed. I do think that we are close to important supportive areas where the gold is likely to build us bullish opportunities. So we have the broken resistance that now becomes support and the lower Bollinger Band. Okay, from upper to lower Bollinger Band could be very good opportunity. Besides that, we have on this rally, we have structure of 3 higher highs, higher lows. That's still trending condition. Okay, currently bullish trending conditions. In a comparison between the first low of this structure to the low of the correction, we would see that while the market is making still higher lows, the indicator could potentially make here lower lows. That's called a hidden divergence. In that case, bullish hidden divergence, okay? Or inverted divergence, some love to call it. And add to that the supportive zone we were just talking about. Add to that the rising supportive line, and we get what? We get a potential zone of buys. And if the long-term buyers are not yet out of the market, which I personally believe they are not, this could turn to be a very nice buy opportunity, at least until this zone would hold. Okay? And what I'll be looking in such cases is the price to finalize the correction while the market, or the sellers in that case, right, making the lower highs, lower lows on the candle. At some point they flip and start to create the higher highs, higher lows. Remember, buyers, when they are in control, they manage to create higher highs, higher lows. It starts with candles, it continues with waves, and then it goes with swing points, and the bigger view of the trends. But when buyers are control, highs are created. It's that simple logic. So this is my view on gold. The current pullback is taking place and very likely coming to the zone where I would start looking for the stop and the reversal. The next one I want to follow up on would be the pound franc, and that is the one we discussed on Monday also. If you missed this analysis, make sure you watch it on Eightcap channel. Subscribe to this channel. All right, if you watch the recording and below the video, you will see the subscribe button, so you stay tuned and up to date when new video is available for you guys. So we were talking about this channel. Okay, it's not 100% parallel channel. However, it's still there. And I mentioned something that I love to do, and that's deviation. The market is not perfect. I don't need to say that, you know that. But why it's important to understand the market is not perfect, because we cannot always anticipate the exact price to be reached, the exact zone to be touched, the exact pattern to be created. No. There is deviation. Sometimes the market is missing a little bit. Sometimes it's crossing more than it should, and it's absolutely normal. It's absolutely fine. Okay. Why? Because the market is not science. There is not science here. It's real buyers and the real sellers. It's a real demand. It's a real supply, and that's why we cannot expect the market to behave perfect in not perfect conditions. So this zone here creates a very strong zone at the bottom of this channel with a longer term view of anticipated second leg upside to build up eventually. That creates a good pressure to the upside. Then we discussed about on the 4-hour chart, when we go to the, bring in here some communication. I need to check it. So what happens here is that we were riding on the lower band, right, for more than 20 candles, right? And I showed the previous examples where such cases happen before. Let me show it once again. You can see we saw it also on the gold before, right? This was on the upper side, this was on the lower side, and every single time the pressure from the market to react to the opposite direction is increasing. Add to that the fact that on the longer term, the anticipation is a move upside, that means that we are already in a zone to start looking for these reversal signs. Well, the first reaction was here, and it was pretty big. It was fast and big. We saw the bottom. We saw the bullish divergence forming on RSI here, and we saw the market react to the upside. Now, does that mean it's over? Or based on a daily chart? I don't know yet, because the daily didn't change yet the corrective structure. It's only the 4-hour chart that made the correction. Well, there are two scenarios which I follow in that case. One of them, one more final push, and then divergence not only on the RSI but also on the MACD, one of my favorite indicators. So while the market will make the lower lows, the indicator should make the higher lows, right? And next to the bottom of the daily channel, this indeed could be an amazing opportunity for a rally. And if the long-term analysis is correct, then once the momentum is gained, this could become a massive move to the upside. You saw by yourself where the top channel goes, right? Let's go back to the daily. You saw the top channel. Well, this could become, like, imagine this scenario happens here, okay? This is a big, big, big move compared to the risk. And for the longer run, the anticipation of the big second wave up is still here. It's still alive. So that's why I love this pair. And just want to make a quick follow-up. We did have the first price reaction at the beginning of the week, right? Right from Monday. And the next scenario which I want to cover is what happens if we don't have a new low. In that case, I will be following for the flip of the structure when the market is making higher highs, higher lows, and then buy the dips back to the supportive zones. The same logic I just showed before on gold. Okay? When the structure is there, we are going back to the supportive zone, supportive trend line, right? And looking for the opportunities to buy them. The most important thing here to remember, guys, at least from my point of view, keep risk reward always in your favor. Whatever the opportunity you are looking for, it's a mistake that a lot of traders, especially beginners, do. They underestimate the power of numbers. What do I mean by that? They are good to risk $100, $200, $500, $1,000, but as soon as they are in profit, they cut out. So you see, you harm yourself by doing that. I mean, psychologically, it's nice to make money on the short term, but for the long run, you harm yourself by such actions. And risk reward is critical in trading. Whatever you are risking, your potential reward has to be positive, in your favor. In the case that you are wrong one time, two times, doesn't matter. Nobody makes 100% accuracy. Nobody. Okay. So on the times you are wrong, you lose your agreed percentage or accepted percentage, 0.5%, 1% per trade. Then by the time you are right, you are making much more. And that's the advantages of such trade of what I call a multi-time frame synchronization. Because if the trend really starts to gain, and your target, in that case, the first target is the upper side of the ball of the channel, right? That's where your risk reward could deliver you great ratio. And that means if you're wrong one time, two times, three times, by the time you are right, okay, the numbers will start work for you. So it's very important whenever you find your trading opportunities, don't find trading opportunities like, oh, okay, so if let's say this is rallies, right? I start to buy here, I risk, let's say that, and that will be my profit. That doesn't make sense. These numbers are not working in your favor. Because in that case, you can be right two times and one time you lose and you're back to nothing. So make sure the numbers are working in your favor. The next one I want to cover would be the German DAX. We still under the bullish pressure, but I'm not going to repeat myself. My video is available from Monday, but we are in two key zones here, guys, which I need you to pay attention to. It's 3 descending wave. Okay? The momentum is decreasing. So the price went above the first Fibonacci zone. You see what I did? I did Fibonacci expansion on these legs, and I got two important zones: the zone of 61 expansion of these legs and the zone of 100. And the closer we get to this zone, the stronger the pressure there will be to go and complete that negative divergence. Higher highs on the chart versus lower highs on the indicator. So we were riding this rally since the last couple of weeks. Our goal was to buy these dips, and the reason I show it to you right now, because we are approaching towards the key zone where it will be smart to consider managing the buys, the profit of the buys, and look for the flips. As soon as we start to see here reversal signs, and this top completes and makes the lower highs on the indicator, makes the divergence, this could be a great indication that the sellers are showing their interest again. And the final one for today would be the Aussie franc. The reason, because this one could be developing something very interesting. What do I see on the Aussie franc, and why do I find it interesting? So after the massive bearish trend and the extreme reaction from oversold conditions, the market made a beautiful rally. But this rally happened to be in two waves, actually like three waves. See, first push, then some stop here with two spikes, and then another rally. Okay, then push down and rally. So this zone, the first zone where the sellers rejected the buyers, create for us a zone of a beautiful demand. And if we take a look here, it's three decreasing waves on the weekly chart with a potential bullish divergence, MACD and RSI. Going down to the daily chart, and what we see here is the same condition of bullish divergence. Lower lows on the chart, higher lows on the indicator, higher lows on RSI. Again, a bullish divergence. So what I want to see here is the market going and breaking above the most recent falling resistance line, above the previous high, holds the momentum, and that should be a great indication that we are ready for a potential trend change. Okay? If that scenario happens, that means buy the dips becomes a good trading plan with several targets in mind. So we connect the first falling highs, the next falling highs, and of course the highs of the swing highs, right, of the previous trend. All these levels would be the levels of target to watch. Now, why there are several targets? It's not because once target reached, that's it, we're out. No, wait for price reaction. If you see suspicious sign and sellers are coming back, that's a good zone to consider management. If the price just goes through the level, which happens, right, then you don't need to do nothing. Enjoy a bigger move. Let the price dictate to you when it's time to step back. If a level is reached, it does not necessarily mean that, that's it, we're out. Why? Why to limit yourself, right? If the market still continues, the momentum is still there, there are no signs against, I'm not talking about one candle against, signs against, a sequence of the rejection around the area, sequence of candles, sequence of swing highs and lows, even on a lower time frame against you, then it will be time to consider to step back. As long as it didn't happen, let it run. So the first sign of the flip for me should be the break above this falling resistance line. And if we go to the 4-hour chart, this could be also classified, just load here, as a double bottom with the bullish divergence pretty much everywhere. And this is the key high. If we go and we manage to hold above that, it should be a very good sign. Okay? Add to that the falling resistance we saw before from the daily. As soon as we go beyond this point, by the pullbacks here could become a very good opportunity. So that's it for today, for the mid-week session. And once again, I would like to say I hope you find some interesting value here and you enjoyed it. Feel free to reach me out in the comments of the recording video or directly in Home Trader Club, and I'll be more than happy to assist and to answer your questions. Thanks a lot for all those of you who made it here live. I wish you a fantastic day ahead, you and yours, and those who are watching the recording. Thanks for your time as well. And I wish you a successful trading week ahead. I'll see you again on Monday. So thanks for being here once again. Enjoy your day and your evening. Bye for now.